I'm Jeff Rodriguez. I'm co-founder of Boost Capital Group. We are a private real estate investment firm and a provider of investment opportunities, risk mitigation, and portfolio diversification through alternative assets. We work with high net worth individuals, busy professionals, provide them passive investment opportunities into real estate and helping them preserve and boost their capital. We are invested in over 2,400 units across multiple states, and we have been investing in assets for over a decade now. Let me go over this quick disclaimer. Boost Capital Group does not provide tax or legal advice. The material here is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy and sell securities. All right, now we got that out of the way. We've covered who Boost Capital Group is. I'll cover our philosophy. So we believe that busy professionals like you should not have to compromise between spending family quality time and securing their financial future. Therefore, we work for you to help find profitable investment opportunities in real estate so that you can continue spending time with your family and being the professional that you are. Now, before we dig into what a real estate fund is, I want to touch base on what a fund is. Basic of a fund is it's an investment vehicle where investors put their resources together in order to invest in securities. And securities that you're familiar with are stocks, bonds, commodities, which create mutual funds, and real estate and crypto. What is a real estate fund? All right, so same thing, same basics of a fund. It's specifically tailored towards real estate investing. What type of assets you would find in a real estate fund can be residential, land, commercial, and commercial is broken down into office spaces, industrial, such as an Amazon warehouse or a big center for like data centers, multifamily apartment complexes, and retail. You also have mixed use, which are retail with some multifamily condos. So there's different variables that go in within commercial real estate. Benefits. So why invest in a real estate fund? So forced appreciation, meaning that you lower the expenses, increase income, applying different metrics. Diversification, because you're investing into a fund, there's multiple assets within a fund. So therefore diversifying your capital among multiple assets and multiple areas. And recession resistance, why is that? Everybody needs food and shelter. There is a deficit of housing right now in the United States, and someone's always going to need somewhere to live. So that's why we consider real estate a recession-resistant asset. Leverage, not only do you leverage the capital that you're pulling into the fund, but you also leverage the expertise and the time of a team of dedicated professionals that are managing the fund. As far as tax benefits, you get tax benefits because you have equity into the deals and you get access to larger deals as a result of pulling your capital through a fund. Now, options of investing into a fund. There are different flavors of funds. Some may not be called funds, but they're still the same process. Real estate investment trusts, which most people are familiar with, Reits. You have syndications where less people are familiar with syndication, real estate equity fund, and then our CPREF, which is a customizable private real estate fund that's fairly new to the space. And we're going to do an overview of all these. First, we're going to go over a real estate investment trust. So a high level, you can find them public or private. They are created similar to a mutual fund. Private REITs, you can buy shares like stocks on publicly traded REIT. Private, not so much. Private, you need to find a broker or someone that has a connection to be able to get you into a private REIT because they're not publicly traded like stock. They manage large real estate portfolios. They could either own the real estate, they operate the real estate, or they could invest capital into a deal by financing the asset. 90% of the taxable income from a REIT is distributed as dividend, and that's by requirements. However, the depreciation is considered into the dividend. Therefore, the tax benefit is achieved before you see it as the investor. So you don't really get much tax benefit from a REIT. And the typical returns are 5 to 6 for public and 7 to 9 for private, and we included a source of that information right there in parentheses. Considerations. So because most of these distributions, the dividend distributions, are non-qualified, meaning they are taxed as ordinary income, therefore leaving a lot of the tax benefits on the table, where you can find in other asset classes. They typically have a higher management fee as well, and we included a source, which is investor.gov. It's a Securities and Exchange Commission website, and they're easier to get in and out because they are acquired through purchase of like shares, and these are for publicly traded REITs. There's a lower barrier of entry because again, they're like sold like shares on public traded REITs, and they do have the same or similar volatility to the stock market. It's in line with gains and losses that you will see in the stock market. Now we talk about syndication, which is not known as wide as REITs. So high level investors also pool the resources to acquire large assets or small portfolios. In syndications, you invest in deal by deal, and you invest with the general partner. So the individual that goes out, finds the properties, underwrites the properties, gets funding, and just pretty much does all the work. You are brought in as a limited partner and you own equity into the deal. There's SEC oversight, Securities and Exchange Commission. And so it requires an SEC lawyer to draw up the PPM, which is a private placement memorandum. It's almost like considering like a business plan. You also get a subscription agreement of what the agreement between you and the sponsor is. You get an investor portal where you access all these documentation, as well as tax documents in the form of K1, which provides your profit and loss statements. Typical returns are targeted to 15 to 17% IRR, which is for a 5-year hold is about 2 times your investment. Considerations. So you're investing passively into these specific deals. So one deal, you're passive into that deal as a limited partner. Now you perform due diligence per deal. So for every deal you get, you're performing due diligence on the sponsor, the deal, the market of where that deal is located. You review the business plan, the PPMs, review underwriting. So everything that you would do in order to perform your proper due diligence per deal. Now, because it's deal by deal situation, there's lack of diversification. Unlike a fund where there's multiple assets in there, a syndication is a deal by deal situation. So the diversification there is limited. The minimum on average is $75,000 to buy into a syndication. And normally it's a 3 to 5 year hold. A real estate equity fund. So it's a partnership established to raise equity for ongoing real estate investments. So an overview of the fund is you're committed to the fund criteria, not specific deal. Unlike a syndication where it's based on the deal's criteria, when you're committed to a fund, you're operating off of those fund criteria as an investor. The diversification is better than the syndication because you're invested in multiple assets. You benefit from pass-through depreciation because you have equity into these deals as well. And we consider this a one-stop shop. So because you're part of a fund, you get access to multiple deals. You also get your PPM and subscription agreement as you do in a syndication. You have an investor portal and you get your tax documentation all in one-stop shop in a fund. And the typical returns are similar to a syndication, which are 15 to 17% IRR. Now, because you're committed to the criteria, the flexibility is not available as much. So if the PPM requires the fund to invest in 50% office buildings, 25% multifamily, and 25% hospitality, we look at the current situation with what happened with COVID. A lot of office spaces were vacated due to government mandate. Therefore, there was a lot of loss of income there, as well as hospitality. Hospitality took a big hit during the COVID situation, and they are recovering now. However, the fund your capital would have took a hit. So you may be locked into the fund criteria even during a market shift. So those are things to consider. There's a lack of deal selection. So when investing into an equity fund, real estate fund, you don't select the deals you invest in. So if you don't share the same market outlook of a specific location and you do not want to invest into, that's part of the fund. So you necessarily do not select what deals you're invested in. It's all within the fund. So therefore, there's low transparency in regards to the individual deal's performance because the returns are blended. So if you have a higher performing property and then you have a lower performing, the returns are averaged and therefore blended, therefore giving you your pretty much overall returns. The hold period depends on the fund cycle. So during the fund, you can be locked in for 10 years because most funds would be operating for about 10 years. You got the capital raising time, the investment time, and then the harvesting period, which would be selling of assets in order to be able to close out the fund. So that could actually last up to 15 years, depending on the fund cycle, the assets acquired, and things of that nature. And also the market, if they have to hold the assets longer, they may request an extension to hold the fund a little bit longer, just to base it off the market, the current situation of the market. Now, here we have the CPREF, Customizable Private Real Estate Fund. So high level, so you get the benefits of a fund and the flexibility of a syndication, specific deal selection. So you can pretty much identify, you have multiple assets in multiple markets. You own equity into the deal as well, and you get the tax benefits such as accelerated depreciation. And these are performed on per asset situation. So you have a cost segregation study that's performed on a property, and within the first couple of years, you get that depreciation on the assets. You also, a one-stop shop, you get PPM, subscription agreement, just like a fund and a syndication. You get your investor portal and your tax documents for all the assets you are invested in. Instead of tracking down multiple K1s for different syndications, you get all your investments in one K1, one tax document for your tax professional or CPA to add to your taxes. Typical returns are targeted at 17% IRR. Now, one thing to consider is that these assets, because it's deal by deal selection, as stated in the last point, most of the assets are going to be targeted at those returns. So these returns are not blended. So it's a better opportunity to pick what assets you want to invest in, therefore increasing your returns versus a blended return from a regular real estate fund. So considerations: minimum investment of $50,000 and 3 to 5 year hold per deal. So not the time frame the fund is open, but this is based on a per deal basis. There's administrative and management fees, just like the other fund. You get to create a portfolio within the fund because due to deal selection, you get to pick what assets you're comfortable with, what markets you share the same outlook with. So if there's a market that you do not like, you do not invest. Therefore, it allows you to create a portfolio within the fund, and therefore increases your diversification. You have more control and more flexibility. And the returns are typically better because instead of investing directly into a syndication at, say, $75,000, if you invest through a fund, which is the pool of capital that's going to a syndication, there's sometimes better returns, higher returns for, let's say, $500,000 investment. But because you only have $75,000 to invest, your capital is pooled, therefore allowing you to get the higher echelon of returns by pulling your capital into this type of fund. And the distributions are made to investors first on a CPREF. Here's a comparison, not necessarily a pros and cons, but just like a quick overview of the positive or the negatives that you would see from investing in these type of assets. Not all assets fit everybody's investment criteria or investment plan. but this is just gives you a quick overview of what would fit your investment plan or criteria. You want to learn more, please reach out. Let's connect. My email address is right there. There's our website, boostmycapital.com. And you could also scan this QR code, which take you directly to our website. And if you have any questions, you want to get on a phone call, need a little bit more granularity on what we presented, feel free to reach out at info@boostmycapital.com. Check out our Facebook, LinkedIn, and we have also some informational videos on our YouTube channel. Thank you and look forward to connecting with you.